Hello and welcome to my short video recording series. The topic I'll be covering today is free cash flows. That's the topic we have for today. So we'll talk about the concept of free cash flow to firm and free cash flow to equity. Before we talk about free cash flow to firm and free cash flow to equity, let's just recap a bit of the income statement. So we know in the income statement, we have what we call earnings before interest and tax, which is profit before interest and tax. From this profit, interest is paid out and interest is deducted. So we subtract interest expense. Let's call that as INT. That's your interest expense. That is what is paid out. The leftover profit is called profit before tax or earnings before tax. Sometimes it's also called pre-tax profit. Out of this profit, of course, you pay income tax expense, or what we call is tax expense. Once that is deducted, the leftover profit is called net profit or your net income or your net earnings. And that's the profit that actually belongs to the shareholders or to the equity holders. And this is the profit which actually gets distributed to equity as dividends. So the profit that belongs to equity holders, as you can see, has to be after interest, right? So the net income which belongs to equity holders has to be after interest, after debt related transaction, which is interest, as well as taxes. EBIT, which is earnings before interest and tax, this is the profit out of which both interest, taxes, and dividends would actually be paid. That's why EBIT is a profit that actually belongs to two parties, or there are two parties that can lay a claim on this profit, or the parties that would actually be paid out of. First is debt, because you pay interest out of this profit to debt holders, and after paying taxes, the rest of the profit belongs to equity holders. That's why EBIT, which is profit before interest and tax, belongs to debt and equity. So the profit that belongs to debt and equity has to be before interest and of course before dividends as well. All right. On the other hand, if we talk about free cash flows, what is free cash flow to equity? This actually represents the capacity of the firm to pay dividends, or the maximum amount that the firm could actually pay as dividends. And the maximum amount that you could pay as dividends is similar to the concept of net income, which is the profit that actually belongs to the equity holders. Of course, it's not same, but it's different. So free cash flow to equity is what belongs to equity holders only. And of course, this has to be after the cash flows, after deduction of interest and after taking into account any debt related transactions. All right, so I'll repeat again, free cash flow to equity is actually the maximum cash available for distribution as dividend. Hence, it represents the capacity. And once you understand it in this way, we'll be able to derive the formula in a much more easier way. On the other hand, free cash flow to firm is the cash flow that is available for payment to both debt holders and equity holders. So the cash that we have available for distribution to debt and equity holders is called free cash flow to firm. And as you can see, this has to be before interest and debt related transactions. So free cash flow to the firm should be pre-interest, while free cash flow to equity should be after interest, just like your profit is. Of course, make no mistake that your profit does not equate to cash, because profit has accrual component as well. Not only the cash component. So we're going to calculate free cash flow to equity and free cash flow to firm, but having this at the back of your mind will certainly help, especially knowing that free cash flow to firm should be before debt and interest related transactions, and free cash flow to equity should be after interest and debt related transactions. With that in mind, let us now try and calculate free cash flow to equity. First, let us come up with the formula for calculating free cash flow to equity. All right, I would assume that you already know what is cash flow from operations, and you already know how to actually calculate CFO, which is cash flow from operations. Just in short, cash flow from operations are the cash flows that you generate from your core operations, which is calculated as inflows minus all outflows. Inflows could be receipts from your customers. Outflows could be payments to suppliers, wages, salaries, etc. When you net them out, the net amount that you get is called CFO. Of course, this is covered in detail in the cash flow statement. So if you need help with this, you can refer to my video on the cash flow statement rating. So I'll take this through an example so that you can see how we can actually come up with free cash flow to equity. Let's suppose a company earns net CFO of around 1 million. Now think about it. Do you think this is what the firm can pay as dividend? So this is the entire, can the firm pay the entire amount as dividend? Of course it can't. It will have to set aside money for some other important matters before it can actually pay the dividends, such as what? First thing is, the firm might want to expand and might need to reinvest into its long-term assets. It might have to incur capital expenditure. So it might have to set aside some money for growth so that it can fund its capex or fund the purchase of long-term assets. So let's say the firm decides to reserve around 200,000 so that it can reinvest and grow, which is called fixed capital investment. In short, we can call this as FCI. So out of 1 million cash flow generated, it reserves money for fixed capital investment worth 200,000. And then what we have, of course, you have to pay debt first before you can actually pay to the equity holders. As we said, free cash flow to the equity should be after debt-related transaction. Bear in mind that interest has already been deducted here from the CFO when calculating the CFO. That's the assumption we are actually making. So then we subtract or we adjust for any debt-related transactions. If you're repaying the debt, then of course it will represent outflow and you will have to pay. Therefore, this should be outflow. So we would say if you're repaying, we will say net debt repayment. On the other hand, if you are actually borrowing, if it's net borrowing, of course, that would actually be added. So minus, let's say the net borrowing or the net debt repayment, sorry, is $250,000. So from your 1 million cash, you reserve money for capex, you would pay your debt first that you'd have to pay, and the leftover is the maximum you can pay to the equity holders as dividend, and that is your $550,000. Well, I won't get into the details between IFRS and US GAAP differences. Of course, you would have to be aware of interest classification under IFRS and US GAAP. That's not needed for your level 1 as such. So as you can see, it's pretty straightforward. Free cash flow to equity, just simply your CFO after capex and after any debt repayment. I repeat again, had it been net borrowing, we would have to add the net borrowings, right? So you need to pay attention to that. As long as you remember this point that FCFE is after debt related transactions, it would be easier to come up with this formula. Let's talk about free cash flow to firm. When we speak about free cash flow to firm, this has to be before interest and before debt, as we said. So if we take CFO, assuming that interest has already been subtracted from the cash flow from operations, we will have to add back interest in order to reverse it. I hope you can recall this from your FRA financial reporting subject, that interest has a tax effect, and you can see that clearly here. So we can only add back interest after tax, so 1 minus tax rate. I'll be covering this separately, the tax effect of interest, that interest is tax deductible. For now, I would assume you already know that. I hope I repeat again that we are adding back interest because it's already deducted from CFO, while we said free cash flow to firm should be both before interest and debt related transactions, meaning we should not be deducting interest, we should not be deducting net repayment or adding the net borrowings. So let's say if the CFO is 1 million, that's what the firm has generated, and we add back interest net of tax as 50,000. Is this the amount of cash that you have available for payment to debt and equity holders? Or are you going to reserve some money for funding growth, for funding your capex first? And that's exactly what you're going to do. You're going to reserve some money for your capex. So that's called fixed capital investment. Say our fixed capital investment is 200,000. The leftover cash is the maximum amount you have available for payment to debt and equity holders, and that simply is $850,000, which is called free cash flow to the firm. So I hope you can see this, the main difference. This should be after debt and after interest, while this should be before debt and before interest. As you can see, we didn't make an adjustment for any net repayment or any net borrowings.